everybody, it's Joe Bladek here today. I'm a mortgage broker right here in Barrie and Aurelia. Today I wanted to take a moment and give a little presentation, a little video on some of the questions I've been asked by someone here in Barrie looking to buy a home. They've gone to their local bank and got a great mortgage rate, and their mortgage specialist has asked them to see if their broker, me, can answer these questions. So one of the first things that this mortgage specialist has said is, well, we can give 10% increase to payments to be able to allow the client to pay down their mortgage as fast as possible. Well, as a mortgage broker, that is the worst prepayment privilege I've seen in the industry. Typically, I see at least 15% or even 20% increase to payments, and that's once per year. Also, there's an annual lump sum payment through this bank of 10% annually, and it can be done once per year. Whereas a lot of the lenders I work with, it's either 15% or 20% of the mortgage balance, the original mortgage balance, and can be done many times throughout the year on any regular scheduled payment date. So if you're paying bi-weekly, that's 26 times per year. Another one, double up payments and access to online banking. Well, a lot of the mortgage lenders in Canada, whether it be a big bank or a mortgage lender that just does mortgages, all have online access now. So you can go in and manipulate your mortgage as well as do lump sum payments right from the online website. So a lot of them do have double up payments as well at better rates than the banks, as well as being able to pre-schedule lump sum mortgage payments as well. Accelerated options for weekly and bi-weekly payments. That's an industry standard at this point. Virtually all big banks, lenders, credit unions offer this type of privilege. Bi-weekly accelerated is obviously better than bi-weekly regular. You get an extra couple payments per year, reducing your entire mortgage by about 2.4 years. Also, this client had come to me saying, you know what? My bank will give me a full service banking account for free if I keep my mortgage there. Well, this is true, and I really can't compete with that as a mortgage broker, but I do know that the rate that this client is being offered is a lot higher than the rate that I'm able to get them. Whereas they will have to pay for their bank account. I've made an example here I'll show you on how I calculate the difference. So the rate I've been able to secure my client is 2.49%. On a monthly basis, that works out to $1,200. And the balance left at maturity is $268,334.94. And the total interest paid over that 5 years is $35,578.14. That's based on a mortgage of $304,800 over a 30-year amortization. Now, if we look at the banking institution that will provide the free bank account, let's take a look at their rate. It's 2.89%. You might think that's not a big deal because I'm getting free banking as well, but the payment's $1,264.23 a month. The balance left at maturity is $270,353.38, and the total interest paid during that 5-year term is $41,407.18. That's based on the same $304,800 mortgage over a 30-year amortization. What do these numbers really mean to you? Well, if you were to take the bank that's giving you that free bank account, you're going to pay $63.51 more per month to have that free bank account. You're going to have $3,810.60 more payments over the entire term of the 5 years. You're going to have $2,018.44 additional money still remaining on your mortgage at the end of that 5 years. And you're going to have paid $5,829.04 more total interest over that 5 years. This is not even for the whole 25 years. This is for the first 5 years. So my question is the free account really worth it? Also, a lot of the lenders I work with do allow payment frequency to be changed at any time without fee, as well as payment dates to be changed at any time as well. I don't really work with lenders that charge a fee to give this ability. If you're looking for a secured line of credit down the road, let me know up front and we can set that up ahead of time so there's no cost to add it on at a later point. That's called a collateral charge mortgage versus a standard charge mortgage. And the difference of those two mortgages is that the collateral charge allows you to add a home equity line of credit at a later point without any legal fees. The difference is if you ever want to leave that financial institution, you'll be subject to about $1,500 extra in legal fees to get rid of that mortgage, to move it to the other financial institution. I also provide portable mortgages as well as mortgages that can be assumed by the buyer so they can take the house with the low interest rate. And my client asked me, do you offer 30-year amortizations? Well, yes, I do. I can actually give you a mortgage of 35-year amortization if you so wish. 35-year right now is the maximum you can do with many of the lenders that I have available. And this client also asked me, because my bank account is at the same financial institution, my mortgage payment will come out, the payment will register instantly. Well, that is true, and that could be looked at as a benefit, but what happens if you forget your mortgage is coming out that day, and you have a financial institution that withdraws the mortgage from your bank account electronically and takes 24 hours to show up? You then have an extra 24 hours to remember to get that money into the bank account. It's kind of like an insurance payment. Sometimes it shows up that day, sometimes it does show up the next day after. And this financial institution claims to be the #1 financial institution in all of Canada. And what happens if the lender that I choose through a mortgage broker goes broke? Well, the Globe and Mail did an article about this, and it'll be listed the link will be listed at the bottom of this video. So feel free to click on it, but there's really no concern about that because some of the lenders that have been, these are some of the lenders I work with, but the lenders that have been shut down recently are first line mortgages, which I think is not on here, but they were required by CIBC. So all the customers were able to have their term of their mortgage honored for the rest of the remaining of the term through CIBC and then renewed with CIBC after. There was also a company called Maple Trust that Scotiabank took over, and they honored the terms of the mortgage, and then they simply became Scotiabank customers after that. So if your mortgage company does go broke, which happens very rarely, they'll just get acquired by another financial institution. And these institutions are giving you money, so they're the ones taking the risk. They're not taking money from you. These are some of the lenders that mortgage brokers work with. So I know this has been a very big, long, and informative video. Feel free to rewind or visit that link on my video. My name is Joe Bladek. I'm a mortgage broker in Barrie, Ontario, and I just wanted to take a moment and explain some of the concerns my client had about mortgage brokers here in Barrie. Thanks very much for watching and have a great day.